In January 2024, Wall Street declared victory over Bitcoin. They rang the bell, they launched the ETFs, and they told the world Bitcoin had finally been brought under control. But buried deep inside those ETF approvals was a rule so quiet, so technical, that almost nobody noticed what it actually meant. The banks didn't capture Bitcoin, they locked themselves out of it. And by the time they realized what they had agreed to, it was already irreversible. This wasn't a regulatory footnote, it was a structural trap. The most powerful financial institutions on Earth celebrated a win while signing away the one thing that actually matters in Bitcoin: control. Today, I'll show you the exact rule that sealed their fate, why it's irreversible, and how it quietly forced Wall Street into a game where Bitcoin owns the field, writes the rules, and decides who gets access. To understand what really happened, you have to understand two words mandated by the SEC: cash only. This single requirement changed everything. In a normal ETF, large banks can deliver the underlying asset directly to create shares. Stocks for shares. Clean, efficient, direct. But with Bitcoin, the SEC explicitly banned that. Banks are not allowed to deliver Bitcoin. They are not allowed to receive Bitcoin. They are not allowed to touch the asset they are selling. They can only move dollars. That means Wall Street institutions are permanently firewalled from the Bitcoin network itself. They never hold the keys. They never interact with the blockchain. They never gain settlement control. They sell exposure, but surrender sovereignty. This was not an accident, and it is not something they can fix later. Once you choose cash only, you are structurally separated from the asset. The banks thought they were buying the team. What they actually bought was a luxury seat, while Bitcoin kept the stadium. You have to appreciate just how long Wall Street fought for this. For over a decade, firm after firm tried to get a spot Bitcoin ETF approved. And for a decade, the SEC kept slamming the door shut, worried about market manipulation. But in 2023, a court called the SEC's denials arbitrary and capricious, forcing the regulator to finally act. And so, on January 10, 2024, the floodgates opened. The Bitcoin ETFs that launched were designed to work like a gold ETF. Instead of messing with crypto exchanges and digital wallets, anyone could now get exposure to Bitcoin's price just by buying a stock ticker like IBIT from BlackRock. This plugged Bitcoin directly into the traditional financial plumbing, allowing trillions of dollars in retirement and investment accounts to flow in. The launch was a massive success. Billions poured into these new funds. It looked like the ultimate validation. This renegade internet money was now packaged and sold by the most powerful financial institutions on the planet. From the outside, it looked like Bitcoin's rebellious youth was over. The grown-ups had arrived, put it in a suit, and absorbed it. It seemed they had taken control. But the cash create rule ensured that Wall Street didn't capture Bitcoin. It ensured that Bitcoin captured Wall Street's capital. The rule structurally blocked Wall Street from creating its own synthetic market. Instead, they were legally required to become the world's biggest, most predictable buyers of actual Bitcoin. They didn't become the new central banks of Bitcoin. They became its biggest customers. This is where the trap snapped shut. Wall Street, with its nearly endless fire hose of cash, became an unstoppable force of demand. But that force was now aimed directly at an immovable object: Bitcoin's rigid, unchangeable, and mathematically enforced code. This collision course is defined by three principles that no bank or government can ever change. First, Bitcoin's absolute scarcity. There will only ever be 21 million Bitcoin. It's written in the code. Unlike dollars, which can be printed, or gold, where high prices lead to more mining, Bitcoin's supply is perfectly finite. By the time the ETFs launched, over 90% of all Bitcoin had already been created. This new, massive wave of demand from Wall Street was hitting a small, shrinking pond of available coins. For every Bitcoin BlackRock buys, It has to convince a holder to sell theirs. They can't make more.
Second is the halving.
Bitcoin's creator also programmed in a recurring supply shock. About every 4 years, the amount of new Bitcoin created is cut in half. In a twist of fate, just a few months after the ETFs launched, the next halving hit in April 2024. The new supply of Bitcoin was cut in half again, from 6.25 to just 3.125 coins per block. At the exact moment Wall Street unleashed the single biggest demand shock in Bitcoin's history, the code triggered one of its biggest supply shocks. The faucets of institutional money were turned on full blast, just as the faucet of new Bitcoin supply was tightened to a trickle. It's a perfect economic storm, programmed over a decade ago. Third, and most important, is Bitcoin's decentralized settlement. In traditional finance, almost anything can be reversed. A mistaken trade can be fixed by a clearinghouse. The system is built on trusted parties who can hit undo. Bitcoin has none of that. Once a transaction is confirmed on the blockchain, it is final. It cannot be changed, censored, or reversed. Not by a bank, not by a government. The banks can offer their customers price exposure to Bitcoin, but they can never control its settlement. They bought a ticket to the game, but they have zero power over the field, the ball, or the referee. The referee is the Bitcoin code, and it treats everyone the same. The launch of the Bitcoin ETFs didn't unite the financial world. It split it. The wild success of the ETFs actually exposed their own structural limitations, forcing the smartest players to look for a better way. Path number 1 is the ETF path. This is for passive investors who want simple price exposure. They're fine with the old model, trusting a third party, in this case, BlackRock and its custodian, to hold the asset for them. You don't own the Bitcoin, you own an IOU that represents the Bitcoin. This path captured the capital of everyone who chose convenience over control. But this led to the rise of path number 2, the path of the sovereign institution. This quiet counter-movement was driven by sophisticated players who looked at the ETF structure and understood the trade-off. They understood the old crypto mantra, not your keys, not your coins. Owning an IOU from a custodian wasn't good enough. This shift was supercharged by a clear change in the regulatory mood. In mid-2024, Congress passed a bipartisan resolution to get rid of a controversial accounting rule known as SAB 121. The rule made it a massive headache for banks to hold crypto for customers. While the resolution was ultimately vetoed, the strong bipartisan support sent a clear signal that the tide was turning against such roadblocks. It showed the deep-seated institutional desire to move beyond the limitations of the ETF. The result was a quiet revolution. While headlines focused on the billions flowing into ETFs, giants like BNY Mellon and State Street began pouring resources into building their own independent crypto custody platforms. They realized that real institutional adoption meant having direct control. They didn't just want price exposure, they wanted to hold their own keys, interact with the blockchain directly, and offer their best clients more than just a simple IOU. And that's the ultimate irony. The ETF, the very product meant to centralize control of Bitcoin, ended up being a massive educational course for the entire financial industry. It taught everyone the difference between owning a stock and owning the actual asset. In doing so, it pushed the most serious, long-term players to embrace Bitcoin's core principle: sovereignty. The market split. The masses took the easy path of the ETF, while the smart money began building for a future where they could truly control their own assets. So what do you think? Was the ETF approval the biggest Trojan horse in financial history? A moment where Wall Street thought it was winning, but was actually being locked into a system it couldn't control? Let me know what you think in the comments. And if you want more deep dives into how our financial world is changing, a quick tap of the like button and subscribing to the channel makes a huge difference. On the surface, the story of the Bitcoin ETFs looked like a conquest. Wall Street, the old empire, had finally captured the digital rebel. The headlines screamed victory, champagne was popped, and the titans of finance took a bow. But when you look beneath the surface, at the cash create plumbing, at the unchangeable math of Bitcoin's scarcity, At the supply shock of the halving and the absolute finality of its settlement, a completely different story appears. It wasn't a story of conquest, it was a story of surrender. The banks didn't lose control on January 10th, 2024. That was just the day they announced a control they never had. The loss of control was written into Bitcoin's code on day one. By creating a product that legally forced them to become the biggest buyers of a provably scarce asset, they became the fuel for Bitcoin's engine. They poured the gasoline of the global financial system into a vehicle they cannot steer. The game has changed. Wall Street is now a player in Bitcoin's world, playing by Bitcoin's rules. They might have the most expensive seats in the stadium, and they might be selling tickets to the masses, but they don't own the stadium, they don't make the rules, and they sure don't control the outcome. The future of finance is being rewritten, not by bankers and skyscrapers, but by decentralized code that is quietly and relentlessly eating their world. So what do you think? Was the ETF approval the biggest Trojan horse in financial history? A moment where Wall Street thought it was winning, but was actually being locked into a system it couldn't control? Let me know what you think in the comments. And if you want more deep dives into how our financial world is changing, a quick tap of the like button and subscribing to the channel makes a huge difference.